Hey, Daniel from Exponential Business Coaching. Do we have a treat for you today? We're going to be interviewing Russell Slappey from Nperspective CFO. We're going to be talking about sales forecasting. One of the great things, if you're a fan or if you follow Exponential Business Coaching, if you subscribe, it's probably because you're amazing at business, sales, and marketing. So with Russell Slappey from Nperspective CFO, he's able to take care of all the things that we kind of are horrible at or we suck at, right? We want to make money, we want to drive sales, and we don't even care about the profit margin. Let's just drive revenue, drive sales, grow the business, grow, right? But I know there is the term grow, gone. Right. So Russell is going to be he's our official fractional CFO that helps and advises us, as well as we refer out to many of our clients. Because people that love sales and marketing and business and entrepreneurship are really great at growing the business, getting out there like a tornado or a pit bull. But hey, there's a lot of problems that can happen if you don't actually pay attention to your financials, your sales forecasting. So Russell, what are some of the biggest pitfalls that you're seeing with your clients that are really growing fast and furious, but then they're actually maybe being counterproductive with growing too fast?
Well, my favorite one with salespeople is more sales volume solves all problems, which is definitely not true.
Russell, our audience is going to disagree with you.
No, the problem with more sales volume is if you're not hitting your gross margin is you cause more problems. So you got to understand your gross margin. You got to make sure you're on targets to grow the gross margin, not just the sales volume. That's massively important when you're trying to grow an organization.
It's funny you say that. Everyone knows one of my mentors, Tony Robbins. He did an event probably 25, 30 years ago, and I forget the numbers, but there was like 30,000 plus people at the event, and he's like, we crushed it. We found out 3 to 6 months later that we lost a shitload of money. Like, so, right?
Not abnormal.
Yes. So that can't happen. So what are we not seeing as business owners, as sales managers, as salespeople? What are we not seeing in the areas of sales forecasting? How are we not seeing from the trees from the forest, or what would you say?
I'd say a lot of organizations, with your advice, I'm sure they're doing okay. However, a lot of times we walk into organizations and they don't really have sales goals established and tied into compensation plans that tie back to the financial modeling and the business plan for the business itself. So if you're not driving gross margin properly to get to the goals of where the organization's heading, then you're missing the boat. And that's got to be incorporated into the salespeople's compensation plans, so it ties into where you want to project the future of the business.
Okay. So here at Exponential Business Coaching, we say that your compensation plan should look like an exponential curve. Okay, would you agree that it's better to maximize the results of the team you already have?
Yeah, but still, you have to look at the incentive of each salesperson, their goals, and how that ties into the future when you're talking about sales forecasting. The whole goal is, what is our strategic plan? Yeah. How do we tie those goals into that strategic plan? Got it. And how do we meet those metrics and pulling that backwards, if you will, down to the day-to-day, and how many deals they close in that day, what's the gross margin of the deals they're closing, how many units, whatever, are sold. If you don't back down from the goal you're trying to set, and that's where you have sales goals, but you have to make sure they're set into the financial goals of the organization. And working with a fractional CFO, that's what we help you accomplish.
Can you give us an example that might better help some of our viewers understand sales forecasting?
Well, oftentimes we walk into clients and they have very simplified, goals set for salespeople, or hey, if I sell so many units, I make 3% of gross sales, or if I make this sales revenue for the month, I get a bonus, or some kind of scale plan or step plan or whatever. But what they're not doing a lot of times is tying that into their financial strategic plan. Okay. So what's our goal? What's our gross margin goal? What's our profitability goal? I often see times where salespeople are incented to sell products or considered loss leaders that have no gross margin. Why the hell are we selling things that...
But Russell, I got to come from the sales and marketing perspective. Yeah. Those get the people in the door. You got the loss leaders, the free coaching sessions, the free thing, the free install on your stereo.
As long as you're coupling that with items that do provide the gross margin and doing kind of a combined plan where if they hit a certain combined gross margin, then they get there. We had a manufacturer where they had loss leaders and they had their standard products and universal products, but they were also selling a lot of loss leader products along with. So what we did is we revamped the sales compensation plan to allow them to sell the loss leaders, as long as we coupled it with the custom products and the universal products, and gave them a bonus based on the net contribution margin that they were achieving on a monthly basis or whatnot. So it's not just looking at you're going to get a commission on each product. If you have a loss leader line of products, you got to look at what's the combined, the aggregate, and then you incent the salespeople on that, not just individual products. A challenge when you're talking about gross margin is the reporting coming from the finance department, right? So part of it is, getting the reporting right, getting it accurate. So when we're reporting back to the sales organization, the salespeople feel like they're earning what they're supposed to earn. So if we don't have the right financial reporting and metrics set up to be able to report back to the sales organization, then they're going to get disappointed. They're going to argue. The salespeople are going to get bad morale.
Yeah.
So it's all about setting up your reporting to go along with your new compensation plan, so that everybody feels like they've been treated fairly and the morale.
So you're telling me that if somebody has an amazing compensation plan, they're earning a ton of money, but with improper sales forecasting, they might not have a job for very long because the company might go out of business,
Yeah,
right?
if we're selling low margin products and things that aren't making money, you'll put us right out of business.
Right.
Volume does not create profit. And that's the big issue, that where the CFO comes in and tries to reformat the sales compensation model to meet with the financial model. And most of our clients are in the sub 100 million. They have limited resources. They have to kind of figure it out as they go. They don't have a lot of outside advice. They can't afford a lot of consultants. The challenge is affording a full-time CFO with benefits and the compensation package they carry if they're a real CFO. Most of the clients don't understand the difference between a controller and a CFO to begin with.
What are the differences between a controller and a CFO?
The controller is typically a historical reporting individual who's looking backwards, looking at trend analysis, analyzing the back data, reporting that financially on the monthly financials. CFOs are more in charge of where are we headed, what's our strategic plan, do we have our forecasting in place, do we have our cash flow forecast in place, how are we going to fund this business growth, do we need investors, is it banking finance, risk mitigation, asset protection for the owners. It's looking at that angle going forward, not backward. I mean, most clients, there's always something finance that can help them, right? Some of it boils down to better financing, better efficiencies within the accounting department, seeing how operations is interacting with finance, better sales compensation goals. When you look at tying sales and operations to finance, that's where the money is. It's that linkage, if you will, that a CFO needs to look at and determine what is the value there. For instance, like we're talking about with the sales forecasting, if I can't forecast the revenue of the business accurately, how can I plan the resources we need in finance, right? That alone is worth all the money in the world. If I can line up the financing needed because I have a accurate forecast, and you wouldn't believe how hard it is for some companies to get an accurate forecast. I go into sales organizations, they can't estimate revenue. Oh, I don't know if that's probable or we're going to hit it. You gotta get an estimate. It doesn't have to be perfect, but that's part of accounting too, is estimating, not actuals, right? Going forward.
Got it.
So how do we forecast properly with estimates, chances of hitting this client and landing this deal and volumes, and laying that into a forecast, working with the sales organization hand in glove to figure that out, get their confidence up on here's how we build that. A lot of times we go into organizations like, I don't know how we can't do that. That's not probable. We don't know. That's not acceptable. You have to set goals and measure against those goals. It's that simple.
So you're not going to come in and tell an organization to stop pushing hard, stop growing, slow down their sales. We gotta, no.
Never. I mean, if they're selling all bad margin products, sure, but that typically isn't the case. Most clients know where they're headed. They've grown the business to a point where they're losing is where they don't realize where they're losing margin. That's the issue, and that's where we help them on the financial reporting end, is understanding where they're losing margin, pushing that back to the sales organization to help them understand what products are not making money.
Right.
Don't focus on those unless they happen to be a loss leader, pointing towards where we make money.
Right.
Coupling those products together in a compensation plan if needed, that kind of stuff. So I had a client recently here in the area that I was working with, and I was trying to land him as a potential client. Basically, he's doing $25 million a year. He's been around, 10 years, good solid business. And he says to me, Russell, I have different suitors coming in and telling me they want to buy out the business, private equity groups, whatever. I said, fine. He said, here's what I'm thinking of. I want an all cash deal, or at least mostly cash, and and this, that, and the other. And I said, okay, I hear you, but what about an earnout? Nobody had approached him with what the hell an earnout was.
Okay.
So what is an earnout? And I said, well, if you had a sales forecast and a projection of the future, I could sell another $4 million in your purchase price on here's where we're headed. Because what I heard in the conversation with you in the last 30 minutes was we got this large customer coming in I didn't have before. Our revenue is going to go up by 40, 50%. Okay, where is that in the negotiation of the sales price? Can't you put that in a projection by using the sales forecast, having a solid sales forecast that's well thought out in detail, working with the sales organization, and then lay that into financial projections and be able to show the potential buyer, hey, what if I hit these metrics? You're going to be making that much cash flow in the future, which of course justifies my sales, a higher purchase price for my organization.
Love it.
That's a perfect example of incorporating the sales forecast into the exit planning strategy and why you need one. Because he had none. And before that conversation, he didn't even think about, I could be selling this for the future value versus the existing value, especially when he already had the contract in place for that next year's revenue already in the hook.
No, did he not know that he didn't know? Was it sort of...
He didn't know what he didn't know. His financial advisors and even the investment bank weren't advising him, I guess maybe not the right conversation, but I pulled it out of him pretty quick. And when he said my sales are going up this year, I'm like, well, did you incorporate that into your purchase price? It's that simple.
Yeah.
But the big key to that is you have to have a well thought out set of sales forecast that ties into your projections for somebody to say, okay, it's well thought out, it's baked in. His idea of a well thought out projection was I increased the revenue 10% and all expenses by 10%. That's not acceptable to a buyer, right?
Correct.
You need to detail it
That's
out,
not how it scales.
the step function of the labor, here's the margin of this new deal, and if you do all that work, they will give you an earnout based on that sales forecast.
Other than reaching out to you, for a free consultation, complimentary, what are some things that that a business owner could put in place or a management team could put in place to help them with this process?
Well, I think it's having the right team of advisors around them, albeit CPA firm, attorneys, fractional CFO firm if they're not big enough yet to hire a full-time CFO. It's always those, when we go into an organization, we typically revamp their whole set of third-party advisors because, as the company grows, they have the individuals on the outside that help them get there, but you have to ante up your third-party advisors as well to help you get better.
What are some things that you recommend where businesses can insulate themselves from black swan events or from, we were talking about the other day about force majeure, right?
Right.
So obviously, like you said, that's more like on the legal side, but...
Well, you can tie that into sales forecasting as well, because what people don't think about is what if sales drop? So when you do forecasting, you should have a best case scenario.
Yes.
Not so bad, and a worst case scenario. And if you already have that plan in place before the actual whatever event takes place, today we were at a client that lost their largest customer. And now we got to help them build that forecast, which isn't in place right now, of how he's going to downsize the organization to go from 4 million to 1.3 million overnight. And if he had that in place, it's understanding what's going to happen right away.
Being proactive
versus reactive.
Yeah.
So now, and by the way, the client has no line of credit. He has no cushion.
Oh, fantastic.
Other than his own personal money, which he has set aside some. But the reality is he should have had a line of credit. I don't know how many clients we walk into and they have no line of credit because they don't believe in debt. Well, the reality is that's what a line of credit's for.
And you can, you said a lot of times you refer
You
that
don't
out.
get a line of credit when you don't need it. You get a
You
line
always
of credit
ask for money when you do.
You don't get a line of credit when you do need it. You get a line of credit when you don't need it.
Absolutely.
So, and that's a big piece of advice we always give to clients. They don't understand what the bank looks at on their balance sheet to get financing. They really don't understand the bank's metrics for offering them financing. And when you teach them, hey, it's 80% of your accounts receivable, 50% of your inventory. This is how it works. There's different types of financing. There's asset-based lenders, factoring. There's traditional lines of credit. There's term loans. There's equipment financing. Walk through all this mezzanine debt. There's private equity groups. They don't understand what's available out there. There is money abundant, but they don't understand what party to go to. They go run out to their bank that provides them, their operating bank account. Well, that's not the right answer.
Correct. Yeah.
So, and it's helping them figure out where to go to that's most of the time most beneficial.
Out of crisis comes opportunity. That's our belief, right? So just give us your thoughts on what you see ahead. And I mean, is Rome metaphorically burning? Like, is it?
Well, I mean, one of the biggest concerns on the finance front would be the interest rates going up. I mean, you know, we're at a point where we've put so much capital into these businesses that otherwise wouldn't have got it. You know, there were a lot of people during COVID that benefited from government programs. Everybody said, "Hey, let's go get it," you know?
Yeah.
Because everybody else is getting it. The problem with that is that creates a economic situation where now we've got tons of debt with the U.S. government on the street, and the only answer to that to keep from what inflation going up is rates got to rise. That's my personal opinion, and I think most business owners know it's coming. So one of the challenges is if you're buying a building, you better get it done. If you're going to revamp your debt and refinance, you better get it done. Consolidate it,
While
you better
rates
get
are
it
low.
done. You better do it now. It's inevitable at this point. I mean, you see it happening on CNN and Wall Street. They're worried about inflation. Well, they're starting to worry because it's coming.
Yeah.
You know, you can't print that much money and not have the offsetting effect, which is we got to have inflation in order to catch it up. Real estate right now, it's going through the roof, isn't that? And it's almost unrealistic. I've lived in Florida 50 years, and it's unrealistic. You know, when things are unbelievable, that's generally when there's a problem.
Yeah.
Right?
Yeah. Absolutely.
So there's signs out there. People don't want to admit to them, but the reality is they're here. So.
I hate to bring up the A word, but are we headed towards austerity? Is that a possibility? Like limited credit?
Well, the first thing, as my mortgage broker said, that you're going to see when something pops. So everybody says, "How does it work?" Well, as soon as there's a scare, all the easy programs disappear.
Sure.
Which then escalate the issue, right? Because everybody's relying on easy finance.
Right.
So, you know, if I can get for instance, if I'm looking at a $2 million home and I can get a 10% down super jumbo loan at a 3% mortgage rate, right? I'm only putting 200 grand down on a $2 million home.
Right.
Well, guess what? That program will disappear the instant there's a market change. Then that slows down buying.
As soon as they start to taper, is that the right term?
Well, as soon as they start raising
increasing rates.
Yeah, because that's a signal, and that'll scare the banks from doing a 10% down super jumbo loan. So when that signal hits, those programs get removed from the marketplace, which also makes it where more people can't buy now. And then the next one goes, and the next one, and the next one.
So if you want capital to start a business, expand a business,
buy a building,
yeah.
Time is now.
Like the scarcity, right?
Yeah.
Okay, that's very interesting.
Because also, don't forget, the investors are going to pull back when something like this starts happening. They're going to pull back into more secure, collateralized loans.
Yeah.
They're not going to be as risque with their money when there's a scare going on.
Yeah.
So you'll start seeing a domino effect.
Right.
You know, in the mortgage side, in the lending side.
Is it doom and gloom? Is it doom and boom?
I don't think it's doom and gloom, but I don't think it's doom and boom.
Any closing thoughts for everybody? We really appreciate you taking the time.
Yeah, I think the best thing we can help organizations with is fine-tuning their sales force forecast and tying that into their financial projections to help the organization.
It's very complimentary. It's very, I don't know, yin and yang, feng shui, whatever it would be. But like the conversations we have, you know, we're both excellent at what we do, but in completely different fields. So yes, we're going to learn a lot more from Russell Slappey. We're going to have you back. We appreciate you taking the time. Link's going to be down below for Nperspective if you want to learn more about him and his Fractional CFO Services. Appreciate you taking the time.
Thank you.
Awesome. Thanks so much. Get Exponential.